does it leave trade tensions? Because there are concerns now with this new security law proposed in Hong Kong that the Americans could react with sanctions. But of course, we've seen the first phase of a trade deal inked in the last few months. Does that mean we now have a broader concern for a lot of investors that that initial trade deal is under threat and more sanctions could be coming?
Yes, in a word, I think absolutely. I mean, I'm being one of the optimists over recent months, sort of post the coronavirus, about how world markets will react. There's an awful lot of liquidity being poured in, but I think the real tension upcoming is not just trade wars, it's capital wars. In fact, I've just authored a book with that title. We're in a world where capital wars matter. And I think if you look at one of the most recent policy statements coming out of the U.S., which is basically the decision to share dollar swap lines with 14 other nations, effectively forming a de facto group of 15 countries, including America, that have access to dollars. That is a critical development. It is the economic equivalent of NATO, which was set up in the late 1940s, early 1950s, to contain the Soviet Union militarily. This is trying to contain China economically. There will be further salvos fired in this capital war, this technology war, this trade war. Essentially, America and China are clear rivals, and the coronavirus crisis has simply accelerated these trends.
Michael, I wanted to pick up on your liquidity point, because obviously there are a lot of people who are watching this run in equity markets and they're beating themselves up because they didn't get aboard and they fixated on the economic damage that they anticipate is being wrought by this virus. They need to think hard, don't they, about that liquidity story, because it is driving financial assets higher. In your assessment, how much longer does this risk-on period run for if we don't continue to get fresh announcements from central banks and governments?
Well, the central bank announcements are critical in terms of what's happening, but one has to look at the scale of the liquidity response, particularly by the Federal Reserve. The Federal Reserve has led, others have followed. That's a normal pattern. But what you're likely to see is something like a balance sheet of central banks, which will exceed $30 trillion by the year end. Given the fact that it's now about, 22 trillion, there's still an awful lot to go. Central bank balance sheets are rocketing, and that will mean that global liquidity rises by about 40% this year, which is a record number. It's never happened before. The last time it happened was 1986, where you saw about a 35% increase. But what did financial assets do at the time? They shared that rise. They rose by a similar amount. And if you look at the total value of world equities relative to the pool of liquidity worldwide, it currently sits at about 30 to 34%. The long run average is about 50%. So the amount of liquidity in the system is driving risk assets up. And that's the reason that I've been so optimistic. It's not about the economy; it's about the amount of liquidity in the system. Money matters, but credit really counts.